You know, everyone says it's impossible to time the market, that it's a fool's game. But what if I told you the pros aren't really trying to predict the future? What if they're just getting incredibly good at reading the present? Well, today we're cracking open the playbook they use to do exactly that.
All right, so first, let's just be real for a second. Trying to time the market, it's usually super frustrating, right? We have all been there. That feeling in your gut that you're just destined to buy at the top and sell at the bottom, turning what should have been a win into a painful loss. That is the timing trap. And believe me, it gets almost everyone.
You know, the huge difference between how amateurs and pros approach this often just boils down to one word: discipline. The amateur approach, it's all emotion. It's chasing whatever sector is hot this week. It's panic selling because of a scary headline. But the professional reality, it's calm, it's systematic, it's patient. It means waiting for a handful of signals to all point in the same direction before making a big move. This whole explainer is about how to make that exact shift. So, how do we get out of that trap? This is the big aha moment. The secret isn't some crystal ball for predicting the future. Nope. It's more like a compass for understanding right here, right now. The pros don't waste their time forecasting what might happen. They focus all their energy on decoding what is happening. And that right there is the fundamental shift in mindset. You have to forget about trying to guess what's going to happen next year or even next quarter. The real power comes from accurately figuring out which phase of the economic cycle we are in today. Think of it like a farmer who knows the seasons. They don't predict the weather. They just know when it's time to plant, when it's time to grow, and when it's time to harvest.
So the economy, it tends to move through these four distinct seasons. It all kicks off with the early cycle. That's the recovery phase. From there, it flows into the mid-cycle, which is a period of really strong expansion. Eventually, though, things mature into the late cycle as growth starts to slow down, and that finally ends in a recession, the contraction phase. Each of these seasons has a totally different feel, a totally different investment climate.
Okay, so if we know these four seasons exist, the next question is pretty obvious, right? What should we be planting? Or for us, where should we be investing our money? Let's start matching the right sectors to each phase of this cycle.
So in the economic spring, that's the early cycle, we start to see these little green shoots of growth. GDP finally turns positive again. And maybe more importantly, credit starts flowing. This kind of environment is just perfect for sectors that are super sensitive to interest rates and to people starting to spend again. We're talking about banks, real estate, and those companies that sell big ticket items. And then things start to really heat up. We hit the summer of the mid-cycle. Growth is strong, unemployment is low, and companies are just crushing their earnings reports. This is when the real growth engines of the market, sectors like technology and industrials, just take off. But summer can't last forever. We enter the autumn of the late cycle. And here, growth starts to cool off a bit, and you might start hearing a lot more about inflation. The smart play here is to start pivoting towards things that hold their value, like energy and other commodities, and also into those defensive businesses. Think consumer staples. Because let's be honest, people are still going to buy toothpaste, no matter what the economy's doing. And finally, winter arrives. The recession hits, GDP actually shrinks, and unemployment starts to rise. In this phase, it's all about one thing: preserving your capital. Investors flee to the classic safe havens. They go to utilities, because we all have to keep the lights on. They go to healthcare, because that's not optional. And of course, they run to government bonds and gold. And this basically puts the entire playbook on one page. It's a roadmap. For every single phase of the cycle, you have a clear plan. Here's what to focus on, here's what to consider, and, maybe just as important, here's what you probably want to avoid. See? It's not about guessing anymore. It's about having a systematic plan, no matter the economic weather. Okay, so this whole framework is great, but it's pretty useless if we can't actually tell which season we're in, right? So how do we know? We follow the data. Let's dig into the key signals the pros are watching to make the call. First things first, and this is probably the most important rule of all, you never ever make a big portfolio shift based on just one piece of data. Ever. The pros, they have a golden rule. They require at least 3 confirming indicators before they act. Think of it like a pilot's pre-flight checklist. It's what keeps you from getting faked out by all the noise in the market. One of the absolute classic signals is the yield curve. Now, normally, if you lend money for a longer time, you expect to get a higher interest rate. Simple, right? But every so often, something weird happens. Short-term rates actually go higher than long-term rates. The curve inverts. And when that happens, it's the bond market screaming that it expects trouble ahead. It has been an unbelievably reliable warning sign for recessions.
Next step, we need to take the economy's pulse. And we do that with something called the manufacturing PMI. It's basically a monthly survey that tells us if the core industrial part of the economy is growing or shrinking. All you need to know is this. A number over 50 means healthy expansion. Below 50 suggests we're hitting the slowdown. It is a fantastic real-time health check.
Ooh, I love this one, the copper to gold ratio. It is such a clever way to gauge the market's mood. See, copper, they call it Dr. Copper. It's vital for building things, so its price reflects economic optimism. Gold, on the other hand, that's what people buy when they're scared. So when this ratio of copper to gold is rising, it means optimism is winning. When it's falling, fear is taking over. So now we have the framework and we have the signals to watch, but there's one final critical piece that holds this entire thing together, and it has everything to do with your mindset. 70%? What in the world is this? Is this how often you need to be right? The score you need on a test? No, this number is actually the key to a much healthier and frankly way less stressful approach to all of this. It's because the goal isn't perfection. It's not about being precisely right every single time you make a move. Real, lasting success in this game comes from being approximately right at the right time. Just letting that sink in. It removes this impossible pressure to try and nail the exact top or the exact bottom of the market.
And this is what that 70% rule looks like in practice. Your goal is to just capture the big, meaty middle part of a major trend, let's say 60 to 70% of the move. And in exchange, you have to accept that you're always going to miss the perfect entry and you're always going to miss the perfect exit. Your focus completely shifts from trying to hit home runs to just avoiding those massive timing disasters that can really wreck a portfolio.
So we can end with this question. Is the market truly just a chaotic, random casino? Or does it actually move with a rhythm, a pulse, a series of seasons that, if you have the right playbook, you can actually start to understand? The pros have already decided how they'd answer that question.